Hello traders, this is Rich from Tradesight. This is the market preview for the coming session. This is going to be for Wednesday, August 21st, 2013. We had a session today where the averages kind of struggled for most of the day, but did wind up closing fairly positively on the day. They were higher before the close, but they kind of broke back down towards the VWAP. The internals have been a little suspect. The advanced declines today were much better than yesterday. We're plus 1,600 issues on New York and plus 1,200 on NASDAQ. But definitely there's some internal conflict going on with the market, and that's definitely going to be the focus of our market preview for this current video. So without further ado, let's go on to, instead of looking at the futures contracts, let's take a look at some of the major market internals, and especially some of the intermarket relationships. So let's take a look at the government bonds represented by the TLT first. All right, here's a look at the TLT. So you can see we've been in this this fairly well pronounced downtrend. The market has definitely been responding to this, putting risk on with the stock type asset classes. But you can see this channel here that we've been into the downside using my e-signal tools, and right now we're about midpoint. The real support's going to come in at the 0 ace line at this 100 level. So for now, we're still kind of slopping to the downside. I think one of the other key breakaways here is this breakdown gap. It's essentially a breakdown gap, and then follow through to the downside. Today we're 6 days down on the secret count. Here's number 6. I just put it in projection mode. So we're 6 days down now in the secret count. If we get to 9 bars down, anywhere near this lower channel or in the 0 ace line, we're going to look for a return to the upside that will probably wind up challenging this this upper trend channel. But we're not there yet. Right now, this is still definitely in a well pronounced downtrend. Next on the intermarket radar, I want to take a look at where we are with the gold index. We're looking at the gold futures right now. Here's the mini gold futures. We swept down below this 1250 area in gold, where we found support. We printed 9 bars down on the seeker, and we've pivoted back above that, and are now actually in a short-term and intermediate-term uptrend because we're above the 10 and the 50 DMA. Right now we're 8 days up as of the close. We're bumping into the static trend line, which is the high water mark of this 1 through 9 seeker setup phase. So this is going to be key resistance here that not a lot of other players have handy. So definitely keep an eye on this. This is about the 1383 area where the static trend line comes into play. So that's been a high so far of this move, and if we need to kind of do a little bit of constructive work under here to base and to consolidate and then break above that, that's definitely going to be the most important breakout point here. To the downside, key support is going to be the 10 EMA, the short term, and much bigger support where this 1/8 Murray math level comes into play with the rising now 50 DMA. I'm going to call it rising because it's just started to slope upward. Here's a look at the oil futures. Oil pushed up here very aggressively out of this little bit of a base, and so far has really just not been able to get all the way up to that 112.50 area, which is going to be key resistance, and 8/8 on the Murray math box. So we've just been in this lateral trading range. We had a breakdown today. Very crude futures were very weak today, losing more than $1.50 to the downside, but it doesn't really change anything because we're still in the same trading range. If we get down to the bottom of this active trading range, we're going to find key support at the 50 DMA, and we're going to find resistance at this 8/8 level at 112.50, and also we're going to see a little bit of resistance from the 13 bars up that are going to print. But keep in mind here that this 1 through 13, here's your 1 candle, and here's your 12. It's been essentially lateral. So this is really a time rather than a nice extended exhaustion that we're going to reverse from or break down from. So this 13 seeker countdown, when it does print, is not going to have the full teeth that it would have if it had a nice extended run to the upside. All right, so elsewhere with the intermarkets, let's take a look at the relationship between the S&P and the NDX. The NDX is the white line here. You can see that we bottomed out here, and we're trading pretty much in lockstep. And then we saw this little bit in the NDX where the NDX started to outperform the broad market. And that's always welcome to the bulls. We are still seeing that that bit of outperformance here because you can see that we haven't really rolled down. We're still holding the breakout level. The breakout level is here. I'll put it on the chart because I think this is important. Here's your breakout level. I'll put a ray on here. Here's your breakout level with the NDX. We came down and retested it, but you can see that we're still above it. The S&P, if I just move the line down to the S&P level, here's the S&P breakout. We broke out, just kind of wandered up here a bit, but you can see that we're back down below that breakout level. So the NDX definitely has relative strength versus the S&P. That's fine. It's okay for the NDX to have strength and have the broad market, the SPX, take a breather. That's fine. What we just want to make sure is that we can see the S&P get back into gear and not completely diverge for too long. All right, so here's the probably the one good leading indicator for the NDX. The NDX divided against the SOX. So you take the SOX divided by the NDX. That gives you this ratio. What you want to see in a healthy market is you want to see this ratio on the rise. When this ratio is on the rise, that means the semiconductors, the SOX, are actually outperforming the NDX. Right now, we're in a period right now where the SOX are actually underperforming the NDX, and they're actually coming into key support in the ratio. This is a very major breakout area. If we go back, and I'll flip this over to the weekly chart, which was very important because that was this major breakdown here in 2012. We've come back up and reclaimed that area, but have not been able to hold it. Now we're falling back down. So this area in the ratio is going to be really important, that we can pivot back this and take another run to the upside. Because if the semiconductors refuse to have a good positive performance, that's definitely going to weigh on the overall NASDAQ 100. So we don't want to see the stocks fall too far behind. All right, we did look at the Dow Gold ratio yesterday. That's the classical intermarket pair. Last night we were kind of in this area. We were falling down, but not really followed through decisively. Now we're starting to see some more downward activity. The ratio, even though stocks were somewhat positive on the day, this ratio is falling down, and that's not good for the market. What you really want to see is you want to see this ratio recapture its positive bias. And right now it's actually adding on to this negative bias and getting more distance below this. This is actually one standard deviation below the low point of this regression channel. All right, so moving on to the major futures index. Here's the ES. The ES had a day where it just kind of fought to hang on. We did have a positive day. I said after 3 days down, here's 1, 2, and 3 days down as of yesterday. Since we were 3 days down, we were not really looking for follow through to the downside, but rather looking for the 50 DMA, which is the red line here, to act like a magnet and just kind of draw up price up to it, and it did that today. I wouldn't be surprised to see that last another day, and just keep in mind that we're setting up this little range here. Essentially the highs and lows from the previous session contain today's session, so we've got kind of an inside day going here. Potentially winding this up with energy. The key level overhead is going to be the 50 DMA at about 1653, 54. Support's going to be the low water of the move so far, which is about 1641, 1642. So that's the range to watch in the next couple of days. The 50 DMA tends to be gained for a day or two, but is not quite like the 200 DMA, which is a more prominent average, which tends to be gained a little bit more and can last, sometimes even weeks. So while we want to respect that we're freshly into the area of the 50 DMA, we also want to understand that it's not quite as potent as the 200. So once we get on the other side of tomorrow's trade, then we have to really take a look at where the range is set up. Here's the NQ futures. NQ futures pretty much just trading in that same range. All these real bodies are still clustered around the same areas here, so we're really not seeing any new technical developments. We're still short-term negative, being below the 10 EMA, but holding above, substantially above the 50 so far. To the downside, if we break the low water mark of this move, about 3066 is going to be important. If we release below that, the static trend line here, the red line, is going to come into play, so make sure you're aware of that. And then, of course, the gap window, which is going to be the high water mark from Monday's trade, and then settlement at 31.25 is going to be in play. All right, folks, as always, thanks for listening. This has been Rich for Tradesight.